All right, let's dive right into this explainer. Today, we're uncovering the mathematical reality behind two totally different approaches to building wealth, day trading versus index funds. And honestly, the gap at the finish line is absolutely going to surprise you.
You know, this is the ultimate trap in finance, confusing being busy with actually getting ahead. We are culturally wired to believe that grinding, working harder, and putting in those extra hours directly translates to making more money. But today, we're running the full numbers to see who actually wins over a 20-year period. Is it the person treating the market like a full-time job, or the person who is, for all intents and purposes, completely checked out?
To keep this comparison perfectly fair, let's meet our two subjects, Ryan and Sam. They're both 28, they both make $55,000 a year, and they're starting with the exact same $30,000 bankroll. Same city, same rent, same starting line. But here's where it changes. Ryan drops $1,500 on a trading course, sets up two glowing monitors, and starts grinding on trades before work and late into the night. Sam? Well, Sam just shrugs, puts his money in a total market index fund, sets up a quiet $200 a month auto deposit, and basically forgets the account even exists.
So, we're going to track their divergent paths across this 20-year journey, from year 1, pushing through the hurdles of years 3, 5, and 10, all the way to year 20. We want to see how statistical odds and human behavior actually compound over time. We'll watch exactly how their differing choices add up, and not just in dollars, but in the time they spend and the hidden costs they end up paying.
Here's the thing, Ryan's path? It definitely feels like winning. He's got the charts, the watch lists, that Discord server packed with rocket emojis. It feels like a real skill. Sam's path just feels, well, boring. Almost like he's giving up. There's literally no confetti on his screen, just a boring confirmation email. But remember, the market doesn't pay you for your effort, it pays you for your edge. And as you'll see, activity is loud, but progress is incredibly silent.
Okay, let's start the clock. Year 1. And we have to be fair here, because in year 1, Ryan's story looks amazing. He hits a hot streak on a couple of tech names, and his $30,000 jumps to $40,000. He is actively beating Sam, who has just slowly drifted up to about $35,000. Ryan feels like a total genius. But actually, this gives him the illusion of skill, which is quite possibly the most dangerous lesson the market can teach a beginner. I mean, a coin landing heads 5 times in a row feels like skill, right? But it isn't.
Fast forward to year 3, and the coin starts landing tails. The hot streak inevitably reverts to the mean, just like they always do, and Ryan falls victim to what traders call revenge trading. It is this brutal, vicious cycle of trying to win back a loss by breaking your own rules. You start taking bigger, way more panicked risks based on pure, unfiltered emotion.
Picture this, it's a random Tuesday in March. Ryan tries to fix a $400 deficit by doubling his position just to win it back fast. Instead, he ends up freezing at his mouse, literally telling himself it's going to bounce back, while the stock plummets right through the floor. Spoiler alert, it did not bounce. That single afternoon cost him $1,100 and probably a week of sleep. And the absolute worst part, he knew he was breaking his own rules the entire time.
Now you might be wondering, is Ryan just unlucky? Nope. He is exactly the median. Look at this massive Brazilian study that tracked day traders over 3 years. Of the committed ones who actually stuck it out past 300 days, 97% lost money. Let that sink in. They didn't just underperform the broader market, they actively lost money. Ryan isn't some weird anomaly. Statistically speaking, he's exactly where the research says he should be.
But let's say you think you've got exceptional skill, that you're going to be in that tiny, elite minority. Well, check out the SPIVA Pro Scorecard. It's a major benchmark tracking institutional performance over a 20-year period. 92% of actual professionals. We're talking people with Bloomberg terminals, massive research teams, and economics PhDs still lose to a simple index fund. So, when a day trader thinks they're the exception, they aren't just competing with other beginners on Reddit, they are losing to the exact same index fund that the best pros in the world lose to.
And here's where it gets really interesting. The activity itself literally bleeds you dry. The market actually charges rent on all this effort you're putting in. Every single trade has a spread, a tiny gap between the buy and sell price. You pay it once, no big deal, but pay it hundreds of times against high-speed machines that react faster than the light from your monitor reaches your eyes? Yeah, you are basically running a business where your only loyal customer is your broker. Let's talk taxes and see how this really builds up, because the law is absolutely not neutral here. When Ryan actually makes a winning trade, it's a short-term gain. That gets skimmed immediately at his ordinary income rate, meaning he's losing 22 to 24% right off the top. But Sam? His long-term gains compound completely untouched for years, and when he finally does decide to sell, it's at a much lower rate, often around 15%. So Ryan's pile is shrinking before it can even start to compound.
Now, combine those short-term taxes with wash sale adjustments. That's a super fun rule that penalizes active traders for claiming losses on assets they quickly buy back. Throw that in the mix, and Ryan's tax return looks like a messy, complicated crime scene. He's got hundreds of trades and a spreadsheet with serious trust issues. Sam's tax return? It's total breeze. Just a normal Tuesday because he never sold anything. There's literally nothing to report.
But honestly, here is the absolute most brutal cost of all. Over 5 years trading 30 to 40 hours a week, Ryan ends up spending up to 10,000 hours of his one and only life just staring at glowing monitors in a dark room. Sam, on the other hand, spent just 1 hour total setting up his auto deposit. If you measure this by the hour, Sam is quietly the highest paid person in this whole scenario, and he was either asleep or just living his life for most of it.
By year 10, the entire shape of the line has changed. Compounding has quietly turned into an absolute monster for Sam, rocketing his account to over $116,000. He's at the point where he's making more from his gains per year than his actual deposits. And Ryan? Well, statistics say that only about 15% of day traders even survive past 3 years. So by year 10, Ryan very likely blew up his account, washed out, and quit a really long time ago.
Now, I want to be totally clear. Index investing isn't some magic risk-free trick. It can be absolutely brutal to sit through. Back in 2008, Sam's fund dropped 37%. More than a third of his wealth just vanished on paper in a matter of months, just like it did for a lot of people in 2020. And in those moments, every single instinct in the human body screams at you to panic sell, to just get out, which is exactly why the average investor often leaves half their gains on the table by flinching.
Make no mistake, Sam felt that panic too. He opened his app, saw the devastating drop, and his thumb definitely hovered right over that sell button. But he didn't press it. That was Sam's truly heroic act. A guy sitting on a couch, simply keeping his thumb off a button. It proves his edge was never about being smarter than Ryan. His entire edge was pure emotional control during an absolute crisis. So, looking at all this cold, hard data objectively, we have to ask the question, is there ever a legitimate mathematical reason to day trade instead of just indexing? Like, is it just completely pointless for everyone?
Well, according to the source material, it really only makes sense in a few super narrow situations. First, if you treat it as a real business with an edge you've rigorously tested and you're risking only a tiny sliver per trade. Second, if you're using it as training for a real career at a prop firm or a quant desk where you actually get a paycheck. Or third, if you're playing with money strictly designated as entertainment. We're talking money you can afford to literally set on fire, kind of like a golf budget.
Because ultimately, day trading is essentially a job with a 99% washout rate that brilliantly markets itself as a shortcut. And the only person reliably making money hand over fist is the guy selling that $1,500 course. Their real edge isn't the stock market at all. Their edge is you, the beginner who's just desperately looking for a way to escape the 9 to 5.
So let's look at that 20-year finish line side by side. The contrast is just staggering. Sam never became an expert. He never learned to read a single candlestick chart, but he's sitting on up to $340,000. Roughly $250,000 of that is pure compounding money that showed up just because he left it alone. Meanwhile, Ryan washed out, lost his money, and honestly, worse than that, he lost thousands of hours of his life that he can never, ever get back.
The great trap here was believing that the effort you put in should automatically match the money you get out. But investing is entirely backwards. The market absolutely does not reward you just for trying hard. Patience looks exactly like laziness, right up until the exact moment it looks like absolute genius.
Now, if you're watching this and you still have that serious itch to trade, there is a totally sane middle path called the 5% line rule. You just dedicate a tiny, separate 5% sliver of your wealth to scratch that trading itch and get the adrenaline rush without ever letting it touch the core money that actually decides your financial future.
So, the next time someone flexes a flashy trading screenshot covered in rocket emojis, don't ask them how much money they made. Ask them what it cost them in the one currency they can never get back, their time. Did they count the hours?
Because the real question isn't just how you grow your wealth, but how much of your actual life you have to trade away to get it.